Hey guys, welcome back to our Philip Training Podcast. I'm your host for today. My name is Aiman and I'm a dealer at Philip Capital. Now, before we start, please take note that this presentation has not been reviewed by the Security Commission Malaysia and is for general education purposes only. It is not an invitation to buy or sell any investment product, hence the speaker of Philip Capital are not liable for any financial decision that you may make based on the content. So I'm not alone today. With us is an extremely experienced speaker, Mr. Daniel Ang. Welcome to our podcast. How are you today?
Thank you very much, Imin. And like I said, I'm happy to be part of your events, and hopefully we can make something out of it.
All right. So before we start, let me just bring you through a quick introduction of our speaker today, Mr. Daniel. Start a career trading commodity futures back in 1985. He went on to be a gold dealer in 1989 before joining Standard Chartered in 1992, where he traded mostly US futures and became one of their vice president. He's currently contract with CME Group as an independent speaker for the Asia Pacific region, and as well the Frankfurt-based Eurex. He also the author of The Accidental Trader, a book available in major bookstore in both Singapore and also Malaysia. So yes, what an interesting speaker we have today. Well, I won't hold too much of your time, so let's get straight into the content. On to you, Daniel.
Thank you very much, and a good afternoon to all of you. So today, we will be talking about oil. Now, so we know that oil market has been quite volatile for quite some time, ever since the start of the war with Iran, and that has been more than 100 days in running, starting from February 28th, and finally we have a somewhat of a peace proposal. Not quite a peace proposal, but an understanding leading to a peace proposal that was signed between the United States and Iran on June the 18th. So that ended roughly about 111 days of hostility between the two of them, of course, in together with the state of Israel. So we all know that since the start of the war, prices of oil has been pretty volatile. However, it has been sliding for the most part since the start of the war in early part of March. We all know that February 28th was a Saturday, and because it's February, it doesn't have 30 days in the calendar month. So the following day was actually a new month in March. And from the day the war started until it both United States and Iran signed a memorandum of understanding. On June the 18th, we saw prices of crude oil rush from a high of $119, drop to below $60 as of last week. And although we only have remaining days to the month of June, we will likely be seeing more volatility going into July, perhaps even into August, because although there has been some kind of a slowdown in hostility leading to the signing of the MOU, we saw that almost immediately both sides has been contesting on exactly what they agree on, from the sanction, from the $300 billion construction fund, as to how to run the Straits of Hormuz and whether Iran has the right to impose a toll. And before this weekend, we knew that both sides has been exchanging fire against each other. That leads to the questionable, the major question that everybody is asking. If there is going to be renewal of hostility between these two, how will crude oil behave? And this morning, we have seen crude oil prices come up to $72.54 early in Asia, from below $70 leading into last weekend. So this is something that we will continue to be concerned with, because at the end of the day, energy prices is the basic production input to any kind of production because you need energy, and the world is still very much depending on fossil fuel for energy. So the price of oil is of concern to everybody, especially in Asia, because Asia we import a fair bit of oil, and about them comes through the Straits of Hormuz. So whether there will be peace, there will be further hostility, will definitely be of concern to nation in this part of the world, especially in Southeast Asia. Now, although Malaysia produces oil, but it is uh, almost a given that Malaysia will still be impacted by the price movements in oil because Malaysia do export their best light sweet crude to the world and then import in the heavy crude from Middle East, and a bulk of them comes from the Strait of Hormuz. So again, it is of major concern to nations in this part of the world. So today we're going to be discussing briefly what we will be talking about in this webinar that will be held on July 21st. And today, just give you a heads up on what will be the main content of that webinar and why you should be concerned, because it will give you a more or less a roadmap as to what experts and analysts are thinking where the crude oil prices may head going into, let's say, Q3 of 2026 and beyond. Do you want me to continue with the breakdown of the content itself? Okay.
And
First of all, I'll be covering on how this issue with the war with Iran started, and of course, I will give you a quick rundown on the timeline leading to let's say July 21st, and whether or not further escalation in hostility between the two will continue, and whether we are looking at perhaps a durable peace going forward. For what is happening right now, that prospect of a durable peace looks like a mirage for time being, because like I said earlier on, within 48 hours of signing the MOU, again, both sides were disputing what they have already agreed as to the who is going to be running the free passage of vessels through the Straits of Hormuz, and of course how the $300 billion in terms of reconstruction fund will be dispersed. And even that, United States and Iran have major differences as how this fund can be used or should be used, and what can they do. Okay, and of course we also want to know the billion-dollar question: will Iran willingly give up the ability to further refine and enrich uranium, leading to the possibility of acquiring a bomb? Okay, although officially that is not Iran's official stand. In fact, there is a fatwa that actually prohibit Iran from acquiring a nuclear weapon, and that fatwa is still very much in place. So Iran has always stated that they are not interested in acquiring a nuclear weapon. However, the West, led by United States and especially Israel, insists that Iran remain a major risk to their existence, especially to Israel. Okay, so the three major parts of the MOU now is in direct contrast in terms of what each side believes they have already agreed upon. So this will be problematic going forward. Now, we're also going to talk about the best case scenario. Best case scenario means oil prices goes back to pre-war levels. Okay, that means below $70 per barrel. And for very briefly, this past week we saw oil prices below $70 per barrel before bouncing up again over the weekend as there were news of increased hostility between the United States and Iran. Okay, so that would be the case whereby we were hoping that peace will prevail in the Middle East, and hopefully crude oil prices can come back to pre-war levels, because elevated oil prices will eventually lead to a global recession, which is not something that everybody wants. It's no longer just between an issue between the United States, Israel against Iran. It is going to be global because the world needs fossil fuel to grow their economy. And in certain places, like say, for example, in East Asia, we have Japan, we have Taiwan, we have South Korea. we practically import all our energy needs. So price of oil will be of major concern because it will lead to, already we are beginning to see inflation resurging in a lot of countries. Okay, and this will be a problem. And this is also accompanied by weakening currencies across the board. We have the Turkish lira, we have the Indian rupee, we have Indonesian rupiah, we have Korean won, the Japanese yen. They are all basically now having to contend with a situation in which their currencies are basically collapsing. And then when you pair it out with elevated inflation, and it looks like you will get increasingly more difficult because they import practically all their oil needs. And this is where we are right now. Going forward into 2027, for example, there is a real risk that the world will enter into a recession. And in certain places, like for example, in Japan or even in Europe, for example, there is a risk of a economic depression because there's a lot of things that has been ongoing even before the start of the war in the Middle East. So this is going to basically exacerbate the stress in terms of their economic growth going forward. Now, the other thing is that we also knew that the UAE has already left OPEC. Now, UAE has been a member of OPEC, which is the oil producing, exporting countries. They have been a member since for 60 over years, and they are a major contributor. But UAE has always felt that they has been penalized for having to observe their quota. Every member of OPEC have a certain quota, and UAE has increased their production capacity, but they were not able to sell as much as they produce by as much as 1 million barrels a day. Okay, so by leaving OPEC, I think UAE is trying to take back its economy and basically decide how to monetize their oil. Now, UAE is also a major exporter of natural gas. Okay, so countries that import natural gas will look towards UAE leaving OPEC with actually with a positive outlook because now they are able to produce as much as they can. The question now is how are they going to export all this energy that they have produced, whether it's LNG or whether it is crude oil, because the bulk of those export unfortunately have to traverse through the Straits of Hormuz. And this is not just UAE alone. We have Iraq, we have Saudi Arabia, and we have the other Gulf nations like Kuwait, Bahrain, Oman. They are all having to traverse, basically use the Strait of Hormuz to actually export their oil. So every day the Strait of Hormuz remains blocked. It means as much as they can produce, they cannot sell. And that will have knock-on effect because the Gulf nations are not poor, they are very rich. But after 3 months of fighting, they have come to a point whereby whatever they produce, they cannot sell. So in the meantime, what they do is they have to store all this energy that they have produced. Now, anybody who has actually observed how oil fields are being run realize that you cannot stop production just because there is some event. Oil fields needs to be continuously be producing because if not, then the oil field runs the danger of not being able to operate. So despite the inability to export oil, they have to revert to storing, but there is always a physical limit to how much they can store. At some point, they will run out of US dollars. Now, there's a lot of countries in the Gulf, especially Saudi Arabia, has committed to very heavy spending. But with the inability to earn US dollars, it is a problem because they have debt to service. Countries like UAE decides that they are actually at the beginning of the war. We have read news report that UAE threatened to price their oil in RMB, which is no as far as the US is concerned. So the UAE has in turn asked the United States Treasury for a credit line, a currency swap. Basically, they need dollars. It's not that they have no money. All their assets are tied, okay, in other assets. And in the meantime, they have to run their country, and they need the dollar. So this is a situation. These are what I call that incidental events as a result of the war that's happening in the Middle East. Now, the reality of the situation here is that Are we likely to see oil prices going back to pre-war levels? I mean, to say below $70 per barrel? The logical part of me is by looking at what's really happening, okay, especially in the immediate aftermath of signing the MOU, we are seeing a return to hostility, which is definitely not a good sign. It means that going forward, we have a real possibility of seeing the entire MOU unravel. And if that is the case, it would logically lead to hostility again. And we are definitely looking at higher prices if that is going to be the case. Now, even in the best of time, assuming today the Straits of Hormuz is unblocked, the Iranian and the US has unblocked the Gulf of Hormuz, for example, and vessels are freely able to traverse up and down the Straits of Hormuz. That would not necessarily bring down the price of oil. Although the initial reaction is as we have seen, when news hit the wire that US and Iran are negotiating for an MOU, oil prices starts to slide. And it continued to slide all the way to, let's say, uh, June 25th, June 25th, which is a Friday. We can see oil prices actually for the first time since the start of the war dip back below $70 very briefly. Okay. So will this so-called good news of lower oil prices continue? That is the million-dollar question. Assuming the strait is unblocked, vessels are able to traverse, and these Gulf nations are able to export their oil, it may not necessarily lead to lower oil prices. Because during the war, Iran knew that they cannot match the US and Israeli militarily. So they have engaged in what we call an asymmetric warfare, meaning to say that uh, they are not able to match the firepower of both the Israelis and the US military. So what they did was they actually retaliated by hitting the Gulf nation instead. And some of that damage has been caused to production infrastructure. For example, in the early days of the conflict itself, UAE has no Qatar. Qatar has more or less voluntarily shut down the LNG facilities. And this is big because when you shut down an LNG facilities, it will take at least 6 months to restart in the best of time. And because some of the infrastructure has actually been damaged, especially in Saudi Arabia, in Kuwait, and very much on the UAE side. Okay, for some reason, the Iranian has hit the UAE a lot harder than they hit Israel. So there are production facilities that has been damaged, and it will take a much, much longer time to rebuild. It takes a lot of money, it takes a lot of expertise to restart those damaged infrastructure, whether they are refineries or whether they are oil producing fields or whether they are downstream facilities. So all this will take time. So that means in the near term, even with the best of time, oil prices is unlikely to stay low for any much longer. What we see in the 2 weeks leading to the signing of the MOU has been a knee-jerk reaction because the market moved on expectation. Now it does looks like that MOU may not is looking like it will unravel. It has become quite untenable if this thing continues. So the whole idea of this is now that we know the news, now we know the drivers, now we know the cost, now that we know what may happen even in the best of time, oil prices will remain volatile, and there is the possibility of profiting from an event like this. Although we are not responsible for the event, we have no control over how this event is going to turn out. But as investor, as a trader, for example, we definitely can profit out of a event like this, even though it is not of our doing. So one of the products you can actually trade to actually take advantage of this reality that we are facing is to trade a product called a NYMEX Micro WTI crude oil futures. Now, this is actually a product that has been launched by the CME Group, basically for the benefit of retail investors. Because if you trade the regular crude oil futures, that product is a little bit too big in terms of contract size. So from time to time, the exchange will be very innovative. They come out with products to make sure that retail investors are not left out of the action. So we will be sharing the contract specification of this product itself, and I will give you my market outlook. So just remember, those are my views and how I will be taking advantage based on what the market is presenting to me, both from the fundamental side and both from the technical analysis side. So this is something that I think will be worthwhile for anybody who are concerned about what's really happening. And the whole idea here is to not be a bystander, not to be a victim, but to take proactive action so that we can at least participate in an event, although we have nothing to do with it. Okay, I always mention that in every crisis there is a silver lining, and in this case, the war in the Middle East, as unfortunate as it is, okay, can be seen to be a event that we can actually monetarily benefit from if we get our outlook correct and positioning correct. I'm actually quite bullish on crude oil. So you know that because of my very bullish view on crude oil, it means that peace is unlikely to prevail for much longer. Okay, even though we have intermittent peace overture, it is very difficult to unravel generation of hostility and mistrust among the nations of the Middle East, especially in regard to Israel. So these are historical baggages. It is not easily resolved. So in the meantime, I'm not very optimistic that we're going to get a positive result out of this negotiation for peace. Okay, and this will be something that I'll be talking about, and I want to share my outlook with all of you, and hopefully we can make something out of this.
All right, there was such an insightful session. Thank you, Mr. Daniel, for the crude oil outlook. For those who are interested to know more, you can join Mr. Daniel's full-length live webinar on the same topic, crude oil outlook, on Tuesday, 21st July, 8 p.m. until 9 p.m. So also, you can utilize insight shared by Mr. Daniel by gaining exposure to the CME market with Philip Capital as low as 4 USD commission fee and could get some reward when you trade. For more info, you can visit our website at philip.com.my. Thank you all for tuning in, and thank you, Mr. Daniel, for your time.
All right, I'll see you guys on the 21st. Okay, that's a date that we have, and I hope to see you all. So in the meantime, you just prepare your question. Anything that you have in mind in regarding to the topic itself, I'll be more than happy to share with you my take.
All right, see you all in the live webinar.